Welcome back to the channel, guys. I wanted to do a video around REITs and properties and investing between them. It's quite a personal thing for me, actually, because 20 years ago, I was at that tipping point on whether I invested in properties or I went into the stock market. And being quite traditional, coming from quite a traditional family, the investment was always bricks and mortar. There was a family business and they did invest in buy-to-lets. And so I mulled this over and thought about it a lot. And I wanted to cover the pros and the cons. As always, I want to take a balanced approach around UK property investing, potentially investing in REIT. And we'll talk about that in a second. But the idea of this video is to talk about the pros and the cons and kind of evaluate so you can make that call yourself. So traditionally, the British dream of being a landlord, I think, is almost dying out now, unless you're taking it as part of an inheritance. I think there's various reasons for that. Section 24 taxes and the 2025 renters' rights bills act as a wealth destroyer. And I kind of want to go into why I believe that is. And this is all personal opinion, obviously nothing, as always, investment advice. I want to go into the pros and the cons and some of the headaches that you receive as a landlord. Now, I did actually rent out property in the past. I've now moved into said property. So I did experience some of these headaches, and I did actually have legal challenges in terms of evicting the tenant. There is things to play in here. I've called it sort of the buy-to-let trap, but obviously I appreciate you've been sold a story of safes as houses, and I was told that. And again, this is of course personal opinion, but in reality, it's your job to keep the property occupied while REITs have leasing teams and you have a second job. So, the tax crackdown, I think, is a big one. So Section 24 tax is turnover, not profit. So you've got that issue. Then you've got the furniture holdings let regime abolishing end tax perks for Airbnbs, for example. The biggest change was the Renters' Right Bill recently. So no Section 21, so that means no fault evictions banned. Indefinite tenancies. Wabb's law, so strict legal deadlines to fix damp and mold. Pet requests, you cannot unreasonably refuse pets now. Bidding wars banned, can't accept offers over asking price. National database, mandatory landlord registration. And then you've got the active job, right? Void periods, average 20 days per year are your problem. Boilers break down on Xmas Eve are your problem. And there's two kind of separate costs here. There's the upfront sunk cost, which is you got a deposit, let's say it's a 200k house, 25% of that 50k. You've then got stamp duty, 3% surcharge. You've got solicitors and surveyors, 2k. You've got EPC, which has come in now as another legislation, so that can be about 8k. You've then got licensing, database fees, another £500. So, you've already got 18k of sunk costs there. And then that doesn't stop there as a one-off cost. You've then got the monthly grind, so the rent that comes in. You've then got against that, you've got mortgage potentially if your interest rates around 5.5. Obviously, people could get better rates or worse rates. You then got agency fees potentially, maintenance fees, the Section 24 tax that I alluded to. So all of this starts to eat into your overall kind of income that you're getting. And then you've got REITs, which basically are vehicles where you can invest in a stock that pays out a dividend or pays out its income. So it lets out, let's say, it could be hospital REITs. You get different types of REITs, but hospital REITs could be storage REITs, etc. And they, with the profits, because of the tax system, favouring them to actually dish you that out as dividends. If we enter the UK REIT establishment, it's a real estate investment trust that allows you to own commercial property without the headache. So it's introduced into the UK in 2007. And for me, it was quite a game changer. As I said, they have this 90% rule. So just like the US, UK REITs must distribute 90% of their tax-exempt property profits to shareholders. So this creates a high, reliable yield paid as monthly or quarterly dividends. The other advantage is because these are stocks, you do have this ISA shield. So you can buy REITs inside a stocks and shares ISA, and your income is 100% tax-free. So no income tax, no capital gains tax, no Section 24. Now, obviously, if you held it outside of the ISA, there would be tax applicable. And if we look at the 10-year projection, so comparing a 50K investment versus a buy-to-let deposit versus a REIT ISA, you can see the impact the buy-to-let has after stamp duty and costs, and how much of a difference that can make in terms of the long-term implications. Obviously, you see the initial drop-off where you've got the initial cost that I shared, the first cost, and then you start to get the monthly costs ongoing after that. So we can see how there is that quite big gap. We've got 60, around 65 coming on to 70K versus over 100K. So it's quite a substantial difference over a 10-year period. So the other advantage is obviously liquidity, right? So you can sell stocks in seconds versus months. The stamp duty, although we do have that on stocks, it's much less at 0.5% versus 3 to 8%. And then obviously, as I said, the tax status, if you put it in a tax wrapper, you can benefit from the tax. The other advantage, you can build an empire very quickly across different types of REITs. Rather than buying a single terrace house, you can diversify, buy UK infrastructure, and you almost become a digital landlord portfolio. So you can own residential REITs, buy to rent giants. Again, I put some tickers here as examples, guys, as none of this is advice on buying these exact tickers, but I always get asked questions or give me an example of one. And so I'm trying to balance the give advice versus sharing example one. So these are just examples, okay? So there is one called GRI, which is an example of which is one of the largest listed residential landlords, owns thousands of modern apartments. From a logistics perspective, you've got Tritax Big Box, which think of it almost like an Amazon landlord. So it owns the massive distribution centers used by Amazon, Tesco, Marks and Spencer. And then you've all got the healthcare sector. So PHP, Primary Healthcare Properties, owns hundreds of primary healthcare facilities. 90% of the rent is effectively backed by the government through the NHS. So you can see how you're able to build up a lot more diversification and spread your capital. You also need less capital to get going as well. Unlike you need that lump sum up front for a property deposit, you don't need that with these stocks. However, I always like to take a balanced approach and always like to analyze the pros and the cons. And I did back then when I was starting to figure out, does it make sense to buy a property and then rent it out, or does it make sense to actually own stocks and REITs? So from a physical buy-to-let perspective, one of the biggest things is you're able to take advantage of leverage. Okay, so banks lend up to 75% loan-to-value ratio, which could amplify your gains. Okay, control, you can renovate and force some appreciation. It's a physical asset you can see and touch, which some people prefer. As I mentioned, the regulatory risk is getting harder and harder now with things like the renters' rights bills, EPC targets, licensing. It can be tax heavy with the stamp duty surge charge, no mortgage reliefs anymore, and it is quite illiquid. So it can take months to sell. So a lot of capital gets trapped very quickly. Whereas if we look at it from the side of a REIT, it can potentially be tax-free. Now, this could be a pro depending on where you put it. Passive, there's zero management. The professional teams handle all the tenants. It's liquid, buy or sell instantly on your phone or on your tablet or on your PC. Cons are it's volatile. So it has a NAV or net asset value. Price fluctuate daily with the stock market. And you could be paying a premium for the assets, or you could be able to buy them at a discount. So there could be a discount to its true value, or sometimes its intrinsic value. You don't have any control. You don't have any influence over the management decisions. They're able to do and make changes as they see fit. And naturally, there is no leverage involved. So you can't safely borrow 75% to invest. You could take out loans, etc., which I would never recommend. There is that aspect as well. Now, obviously, this is all for education purposes only, but I just wanted to go through a personal journey that I've experienced. And as I said, I did end up renting out the house that I now live in, and it was a nightmare to go through in terms of the rent collection, the taxes, getting back the property when they were not paying. And so I kind of did experience it. Maybe I didn't have a good experience and that didn't help. But I also like the fact that I've got these digital REITs that I can diversify into different portfolios, and it can add a bit of income, and I can put it ultimately into a tax wrapper, which, as you all know, I'm quite keen to use these tax wrappers. Obviously, past performance doesn't obviously guarantee the future results, as always. I think it's something, if you are in the more traditional bricks and mortar, to explore REITs, and maybe if you are in REITs and digital, you are thinking about buy to let. Let me know in the comments, by the way, whether you own properties that you buy to let. How do you feel about them? Do you invest in any REITs? If you do, which ones? And do you prefer the REIT or digital approach, or are you more aligned to the kind of bricks and mortar, the buy to let approach? Let me know in the comments. I'd be curious to know how people are investing in this sort of space. Okay, guys, thanks for watching, and I will catch you on the next one.